Hello and welcome to another episode of Ezoic Explains. Today I'm going to be going over the difference between what a CPM, a CPC, and a CPA is. So, what is the difference between a CPM, a CPC, and a CPA? CPM stands for cost per mille, 1,000 visitors. So mille means 1,000 in Latin, so it's cost per 1,000 visitors. CPC is the cost per click, and CPA stands for cost per acquisition. So CPM, cost per 1,000 visitors. This is a metric mostly for advertisers. It lets advertisers reach a large amount of people at once, and it doesn't require anybody to click on anything, so a lot of advertisers will use this for brand awareness. It is a cost per impression, which is eyes on a site. A CPM can be anywhere from a couple of cents to thousands of dollars. It all depends on how valuable that ad location is, depending on its target audience and that website's traffic and content. So you can see the formula here for cost per 1,000 visits, and it is the total amount spent divided by the total measured impressions, and then you multiply that by 1,000, and that is the CPM. You can see that here. Let's say that the total amount spent on the ad was $1, and there were 2,000 impressions. And so then you multiply that by 1,000, and it is a 50-cent CPM. So some pros and cons of CPMs is there is a predetermined payment amount, so that's predictable. It is most predictable income stream for publishers. Publishers can easily see the value delivered to advertisers. However, it's not a good metric for publishers to gauge how successful their site is because it doesn't show you what your entire site is actually worth. It's just what advertisers are willing to pay. So it's not a good gauge for publishers. It is the cheapest for advertisers and the lowest risk. So usually that means if it's the best for advertisers, it's probably the worst for publishers. CPC is cost per click. And this is a metric for websites. It is possible to set a maximum budget in CPC campaigns so that when the agreed number of clicks is reached, the advertisement will no longer show. So this is kind of a safeguard for advertisers if they don't want to spend more money than a certain amount, and they can agree upon a certain amount of clicks and then the ad will shut off. And this is good for publishers because you can collect data on visitors who clicked on certain ads, so you can better understand what deals you should invest in the future. So this is just another way to understand your audience and what kind of deals that they're going to want to see and that you should invest in. So CPC is the total money spent divided by total measured clicks. That will give you your cost per click. So as we can see, if the total money spent is $1 once again, and it received 100 clicks, the CPC is 1 cent. 1 cent per click. The rate websites charge advertisers for every click an ad receives, a more measurable investment for advertisers, but less predictable. So there's a pro and a con. Visitors clicking advertisements will take them away from your site, which you don't want, so that's a con. And publishers have to really understand their audience to put the right ads on the right pages of their website so people will click on it. And this is a little risk for advertisers because basically someone has to click on the ad. It's a bigger risk for publishers because you have to really know your visitors and expect them to click on that ad in order to receive anything from them. CPA is cost per acquisition. This is probably the worst one for publishers. It's also called pay per performance, PPM. The advertising network provides sales and installation. It's kind of similar to affiliate ads, although that's a link to a product. And it's the least amount of risk to advertisers, but is the highest amount of risk to publishers. So CPA is the total ad spend divided by total attributed conversions. See that here? Let's say they spent $5 on an ad and 10 people purchased something once they clicked on the ad. That means that you have earned 50 cents. So that's quite a low amount to earn for basically a bunch of effort and depending on your visitors to go purchase something. So you only get paid if a user takes a certain action, which is usually purchasing something. And you will need to spend more time and expertise towards making sure that that ad leads to a sale. So once again, you really have to know your audience and expect them to click and then purchase something. So it has to be something that they'd really want, and your content has to be really relevant to that. And it is high risk and then high-ish reward. You could hit it big time, but really it's just an inconsistent and unreliable way for publishers to make money, and it is really the best for advertisers. As you've probably heard before, we recommend that you look at your site's EPMV and that you don't worry about these metrics. EPMV stands for earnings per mille, which is Latin for 1,000 visitors, so earnings per 1,000 visitors. This is the revenue made by a publisher per 1,000 visits. And what's best about EPMV is that it accounts for UX, like multiple page views, time on site, scroll depth, and bounce rate. And it can be used to measure all of your revenue sources, not just advertising impressions. So this is really just a way to measure your overall website health and how much it's actually worth. It takes into account if a visitor is going to visit multiple pages and there's going to be more ads on those pages, which is what you want. You want your time on site to be higher and higher. And so this is the best way to measure if people are actually enjoying your entire website. So we have an EPMV formula here. You have the total sessions divided by 1,000 and then divided by the total revenue. So for example, we have here 2,000 total sessions divided by 1,000, and then you divide that by $26. Let's say that was your total revenue. That means you have a $13 EPMV. And that's it for this episode of Ezoic Explains. I hope that this was helpful for you. If you liked this video, please subscribe to our channel, subscribe to our playlist. You can find us on Instagram, Twitter, LinkedIn, Facebook, ezoic.com. We also have a blog at ezoic.com/blog. This has been another episode of Ezoic Explains.